FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and guess what? It's 10/7/19. Hey, first of all, I was in New York. Shout out to my daughter's late father-in-law, John Kirby. Put a link to his obituary in the show notes here. An amazing man who accomplished so much, was a brilliant lawyer, far brilliant than I could ever hope to be, and an amazing human being. Somebody to look up to, believe in. Well, talking about believing in things, the U.S. dollar, it really is the Taj Mahal of Baltimore. Everyone wants it and nobody can get it. There's a shortage of dollars. Is that going to lead to a run on banks? What about what's happening in Hong Kong? Will the Chinese go Tiananmen, or will they try a softer, gentler form of repression? Well, it doesn't look like that's working out too well. Anyway, someone who does work out well is John Rubino, dollarcollapse.com. John, hey, we're back to square one here. Tiananmen Square, that is. Is Hong Kong going to turn into Beijing?
Hey, Kerry. That's the big risk for Hong Kong now, is that China's going to lose patience, because these protests are just going on and on and on. And I think the first guy got shot a couple of days ago. Mm-hmm. So that's an escalation, where the police and the soldiers shot one of the protesters and then arrested him. He didn't die, so they arrested him after that. But you got to figure that China is looking back to its experience with Tiananmen Square and thinking that, hey, they totally got away with it. You know, it was a little stressful in the short run, but they made their point, and they didn't really suffer in the long run from it, which is kind of how it works for dictators out there. Have you noticed? You know, Putin just kills people with abandon. He poisons them in Europe and gets away with it. Yeah. And the head of Saudi Arabia chopped up that Washington Post columnist or contributor or whatever he was a while ago, and that was like a 2-week story, and now nobody's talking about it. Saudi Arabia is moving on with its war in Yemen and oil sales and whatever else they do over there. So China probably thinks that history is on its side, and that if it has to go in and really crack down on Hong Kong and just quell dissent, with whatever body count that requires. And you have to wonder when it's going to happen, because their patience is clearly diminishing, because this has been going on for a long time, and they've been issuing a lot of threats, and they're going to have to make good on those threats at some point. So historically, they probably think they can get away with whatever they need to do. And, Putin in Russia kills whoever he feels like and gets away with it. And the head of Saudi Arabia just killed that Washington Post contributor and got away with it. So it's something that they probably think if they have to do it, they can do it. The problem is Hong Kong is, first of all, a really highly leveraged economy. You know, it's a banking center, and their banks are very leveraged, and that makes them kind of fragile. And they're big enough to be important to at least the Asian economy and maybe to the global economy. So this isn't a risk-free thing if China decides to resolve the Hong Kong protests violently. But meanwhile, that's not the only piece of civil unrest we've got going on in the world. Ecuador just had to declare a national emergency because of mass protests that were turning violent. Haiti's got kind of the same thing going on. In Iraq, they're shooting into crowds, and so far 40 or 50 people have been killed because there are anti-government protests that are springing up pretty much everywhere. So civil unrest is starting to spread around the world, and each place kind of has a unique set of motivations and reasons for it happening, but a lot of it is economic. The government is failing to give people what they need, and they're rising up and demanding that there, fundamental change that gets them what they need. And this is how it works in an indebted world, which we are right now, where the more money you owe, the harder it is to take care of stuff in the present, because so much of your income is going to interest, and your borrowing power diminishes accordingly. So this is the kind of thing that we'll see going forward probably increase, just because that's how it works when governments can't just create a bunch of money out of thin air or borrow it or whatever and use it to make life easier for voters and workers. And as that gets harder and harder, more and more people are going to demand some kind of a change, and maybe they're going to demand it in the streets. And so that's just coming. But the fact that we're seeing all these things spring up for no apparent immediate reason in a lot of different parts of the world means that that's one more data point that should be a cause of stress for the global financial system. And maybe it will be once the stock market turns down, or once the bond market starts to behave really erratically, people start looking around for reasons for why that could happen. And there will be a lot of things to find when the time comes. But at the moment, things are actually fairly placid this last week in the financial markets. The Fed has intervened. They basically started QE again.
Yeah.
With these repo cash infusions. They're doing it in a different way. They're just giving the money directly to banks in the overnight market, or very short-term debt markets. But the Fed's balance sheet is starting to increase again, which is to say that the amount of currency, newly created dollars that they're pumping into the system is growing again rather than shrinking. Mm-hmm. So we've also hit that inflection point where tightening has become easing. So now we've got rising interest rates becoming falling interest rates, and monetary tightening becoming monetary easing in the United States. And the fact that Germany just put out a report that implies they're in recession right now, leads to the conclusion that the European Central Bank is going to have to start easing aggressively too. And they've already committed to it. Mario Draghi, on his way out as the chair of the ECB, basically made a lot of really aggressive promises that he's saddling his successor with. So the ECB is going to be an aggressive monetary force in the world going forward. The Fed looks like it's going to be easing aggressively going forward, even though they're trying to minimize the promises that they make. And they're saying, well, this might be the last interest rate cut, blah, blah, blah. But then that's not working, because as soon as the market thinks there are no more interest rates coming, it flakes out collapse. And stocks tank. So basically, the whole world is going to be in easing mode here. And that's traditionally good for financial asset prices. But at the same time, the whole world is in, under a lot of stress for other reasons. The stuff that's going on in the Middle East, and the civil unrest around the world, and financial asset prices at extremely high levels, which means that there can be air pockets under the prices of stocks and bonds with any kind of a hiccup in the orderly functioning of those markets. So we're creating some very big forces on either side of the financial market right now. Aggressive monetary easing, at the same time, financial fragility is rising dramatically, which means volatility. That's the only thing that you can say with absolute certainty going forward, is that things are going to be volatile, because when one thing happens, the reaction has to be fast and powerful to an extent that it hasn't been in the past, which means that you get volatility in one direction, then volatility in the other direction. And that's what we're looking for going forward. That's what we'll see, and that's what we'll have to deal with as investors. Because this is fun theater; it's fun to talk about, but what we really have to do is figure out how to organize our finances in a world that's becoming more and more volatile. And that's really a tough intellectual challenge, because if you want to go conservative, you get zero current income.
Yes.
And maybe negative current income in the not too distant future. In other words, if you buy treasury bonds and money market funds, which, by the way, a lot of people are doing, the money market funds are seeing massive inflows right now, which is a sign of stress in the financial markets. People are going for safety, and they perceive money market funds to be safe, but they weren't safe last time around. The government had to bail them out, basically. So it could happen again here. But if you do that, you get no current income. And a lot of people and a lot of entities need income. If you're a retiree and you base your retirement plan on being able to generate 6% risk-free in bank CDs and intermediate term bond funds, and now you're getting 0.2% instead of that 6%, you've got a big problem. If you're a pension fund and you need 7% going forward, or maybe even 8% in the case of some of these crazy pension funds out there, in order to pay the benefits that people have accrued as part of that plan, what do? Part of your portfolio has to be fixed income, but that fixed income doesn't yield anything. So you kind of have to go further out on the risk spectrum to get this thing that you need. So pension funds are buying junk bonds, and they're buying emerging market debt where there are still positive interest rates, and they're buying stocks, and they're buying real estate. All of these things that do great in good times and get crushed in bad times. So we're turning pension funds and retirees into hedge funds, which, if you're a hedge fund manager, you expect a couple of big down years every once in a while in return for the outsized returns that you're trying to generate by taking on a lot of risk. If you're a retiree, that's not part of the package. You don't want to lose 30% of your nest egg over the course of 2 or 3 years, because then you have to eat dog food or move in with your grandkids. That's the last thing you want to happen, but it's the kind of thing that the markets are forcing people into right now. And if you're a pension fund and you're already underfunded, what happens when you lose 20% instead of making that 7% that you were supposed to make? It means your underfunding becomes a political issue. And they kick out the money managers who caused the problem, quote unquote, caused the problem, when really it was the politicians who did it. And they replace them with other money managers. So you lose your job if you're the pension fund guy who did that. But you have no choice but to take that risk now, because the alternative will also get you kicked out of your job. So that's our world. And all of that means huge volatility going forward, just because there are people who are taking on higher and higher levels of risk who shouldn't be taking on any risk at all, really, or minimal risk. And the fact that everybody now is highly leveraged, you don't have a risk-averse, extremely low risk sector in the investment community anymore. There's just nobody out there. I mean, even muni bonds, that used to be the safest thing in the world. And now a big chunk of the muni bond market is Chicago and Illinois and New Jersey and New York and Kentucky and California, these places with massive unfunded liabilities that they're borrowing money. They're issuing bonds in order to cover their pension liabilities. And people are buying those bonds, but that just makes the muni bond market extremely volatile too. So we might have to title this talk, Gary, Volatility is Coming, or something like that, huh? Because I'm going on and on about
it's here. Volatility is here.
Well, it is. The last few months have been extremely volatile in the stock and bond markets. Interest rates plunged, and people just got used to it. The 10-year Treasury goes from 2.3% to a yield of 1.5%. And it gets a few mentions while it's happening. And now people are just thinking that 1.5% is normal on a 10-year Treasury. And when it goes to zero, I suppose we'll go through that same thought process where it's a big deal and it gets a lot of headlines at first. And then we just sit back and take the fact that 10-year Treasuries are zero and mortgage rates are 1.5% as the new normal until it blows up, and everything's going to seem normal as long as the financial markets are behaving more or less normally. And as soon as they stop, as soon as they experience a discontinuity or volatility that just can't be hidden anymore, then things won't seem normal. But right now, people are very adaptable. They're surprisingly adaptable in the face of these amazing changes in interest rates and stock prices and foreign affairs. So.
Yes, it's very true. I mean, everything seems normal until one day everything's not going to seem normal. And we're going to see that soon enough, aren't we?
Well, we've been saying this for quite a while, that the end is near. And it seemed like the end was near because the numbers a decade ago were historically crazy. and they've just continued to get more and more crazy. So we're heading for a place where the numbers don't work anymore.
Yeah.
But we don't know in terms of time where that place is, or in terms of numbers. What is the number that blows this whole thing up? How far down can interest rates go? How high can stock prices go? How much debt can the government take on? How much debt can students take on? Student loan debt just reached $1.6 trillion. And I remember when it broke $1 trillion, that was front page news.
That was huge.
Yeah. And now it's up by another 50%. And it is not front page news anymore. It's just the kind of thing where you see a tiny little headline somewhere and then you don't see anything about it again. So we're becoming conditioned to expect crazy numbers that don't have any impact on the world. And so the next set of crazy numbers doesn't faze anybody, which is sort of how you get to really dangerous places. Once you get so conditioned to ignore numbers that should scream, get out now, leave this casino right this minute.
Yeah.
And you stay in, then the system gets so leveraged where with everybody in, we're all in on growth stocks, and we're all in with treasury bonds at historically low interest rates or negative interest rates in Europe and Japan. We've created the conditions in which the numbers that would have seemed crazy just a few years ago are now normal.
Madness.
And people are trading these instruments like they actually have some value, which they don't anymore.
Hey, I sent you that thing. Hold on a second. I'm going to find it. Where Charlton Heston, it's Planet of the Apes.
Yeah.
It's a madhouse.
It's a madhouse.
We got to play this. We got to play this. Planet of the Apes Madhouse. It's just the best. Okay, here. I'm going to play it right now. Stay tuned.
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential as past drilling has outlined deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
All right. Here we go.
It's a madhouse! A madhouse!
In case you've never seen that one, from Planet of the Apes, Charlton Heston is getting hit by a fire hose by one of the apes. And he's saying, it's a madhouse. It's a madhouse. And it's just a really great spot. I love it. So anyway, it's a madhouse. It'll continue being a madhouse until sanity one day again prevails. Whenever that's going to happen, I don't know, but maybe one day soon, John.
Well, one of these days, Kerry. In the meantime, the gold bugs and the rest of the sound money community will just keep on pointing out that these numbers don't work anymore. Yes. And at some point they will break the system, but we're heading that way. And, politically in the U.S., there's no sign that this is going to end. If Trump stays in office, we're going to run $1 trillion deficits forever. Bernie Sanders is out of the hospital and he's issuing plans, which is really smart.
That's insane.
Yeah. He what?
That's insane. The guy cannot keep up his run for president. He's 76 or 7. He just had a myocardial infarction, a heart attack, a blockage in one of his arteries, and they're going to call him President Stent.
Well,
I just don't think he can do it.
He has to come back and look energetic in the next debate, and people forget this. And then he has to name a young running mate. Got to be somebody who's, I would love it to be Tulsi Gabbard. That would be awesome. That would
be the ultimate.
It's got to be somebody with some credibility who's young and strong and with no health problem.
Yeah, good luck. It's just not going to happen. Sorry to say. He's finished.
Well,
it's over. He's done. The guy had a heart attack and he's 76. He has no business being there, and he will be driven out. I'm just telling you my opinion.
Well, we'll see. I mean, but you have to, it's all a relative thing though, right? Because if he leaves, then we're back to Biden.
Oh, Biden's finished.
And so, Elizabeth Warren is looking better and better at this point because Biden and Bernie Sanders are both tainted by various things right now.
I don't think she's looking better. She's like the U.S. dollar. She's the Taj Mahal of Baltimore.
Yeah,
you know?
Yeah. Well, she's looking relatively good in the Democrat primaries right now because she's the only one where there isn't this big thing hanging over her head. The Pocahontas thing is pretty damaging, but
that's pretty damn damaging.
Her health isn't in question. Her ethics are not immediately in question financially, at least. She somehow so far has avoided stealing any money, unlike a lot of these other guys, or being caught stealing money. So it's looking good for her, which is a scary thing for Wall Street because they don't want wealth taxes and they don't want taxes on stock trading. One thing that would be great to see though was that it would be like a penny tax on all financial trades, which is that's a left-wing idea, but it addresses something that everybody should be worried about, which is high-frequency trading and robots running the stock market.
Just overall financialization. It's something that's not desirable. It's totally malinvestment. It turns all markets into casinos and winds up making everything not function properly, which is why we are where we are now. So it needs to be gotten rid of. And, it's a parasitic endeavor. What did Matt Taibbi call it? The giant vampire squid, Goldman Sachs. That's what it really is.
Well, see, that will be one of the fun things about the coming election is if the Democrats put somebody up who overtly proposes some kind of a regulation or a tax on stuff like high frequency trading, because Wall Street will go ballistic. They make so much money.
High frequency fraud.
Yeah. Well, it is. I mean, it is fraud. A lot of what high frequency trading involves is stuff like front running that we used to consider to be fraud and spoofing and stuff like that. But somehow they're getting away with it. And partially how they're getting away with it is that they can finance so many election campaigns in Washington that most of the financial oversight committees are staffed with people who are beholden to Wall Street, who are willing to overlook stuff like that. So get somebody out there who's going after those practices. And maybe it doesn't work in the end. Maybe they don't succeed, but it'll be fun to watch because it's fun to watch people who are scamming be exposed and squirm, because they always think they can get away with it for a while longer. And that's what Wall Street will do. They'll come out with all kinds of explanations about why that's a bad idea and how it would, hurt liquidity in the financial markets. And it's all a lie. But the squirming will be fun to watch. That's all I'm saying.
Yeah. No, I totally agree. I think anything you can do to make this thing more rational, to make business just happen better in a more efficient way without these parasitic enterprises, because that's what they are. They're just parasites. And, throughout history, financiers have always bemoaned the whole thing of Wall Street, that it exists, that it's, that it's there at all, and that it extracts these giant amounts of tribute just to give you what it does, which is access to capital. There's something really wrong with it. It needs to be halted, and yet we just can't seem to be able to do anything about it, John.
Well, we should preface this by saying that there's nothing wrong with being a banker or an investment banker or a money manager. Those are all noble professions. But when an industry, any industry, it's just human nature, becomes too powerful, they become corrupted by that power.
Yeah.
And in this era, it's the finance industry that has accumulated too much power and is using that power to manipulate the political system and to enrich themselves at the expense of everybody else. So without saying, bankers are bad people, although I think we could get along with a lot fewer derivatives traders, personally, but without saying these are bad guys, we can say that the industries in which they work have become corrupted and have to be scaled back dramatically. And at the extremes of the financial pendulum swings, like during the Great Depression, for instance, that's when this kind of reorganization can happen.
It needs to happen.
In the 1930s, they scaled back corporate monopolies and they broke the banks up into two different kinds, one of which could go bankrupt and one of which was insured by the government and did different things. So we could do something like that again very easily in the next crisis. And it's not this kind of earth-shattering thing. It's just something that happens periodically in a capitalist system when one industry or one group of industries accumulates too much power and has to be put back in its place. And finance has that coming in the not too distant future. I
certainly do.
It now, there are Democrats running on a platform of doing that, and they're getting a lot of votes, which means that the idea is moving into the mainstream. Breaking up the big banks, imposing taxes on stock trading and stuff like that, and then derivatives trading. Those are going to be mainstream ideas in the not too distant future. So there's a good chance that we get something like that eventually.
It's just the thing is, that these guys are not sincere. Elizabeth Warren is just a total phony and a fraud. And from Pocahontas, now she said she was not allowed to continue teaching because she was pregnant, which turned out to be a lie. She's just a total congenital liar.
But that's not the point, though, in terms of financial re-regulation. The point is that the ideas that she's proposing, whether she's sincere or not, are generating a lot of positive interest out there.
Yeah.
In other words, they're popular ideas. And just like with Trump, the trade war and the wall and everything turned out to be popular ideas.
Yeah.
And they got him elected, and they're holding his base. Well, on the left, the idea of breaking up the big banks, financial re-regulation in a lot of ways, is now very popular. And you can get nominated in the Democrat Party on a platform that includes stuff like that. Now, the question is, can you get elected in a national election? We'll see. But it looks like whoever wins the Democrat primary, because it's not going to be Biden now, a Wall Street Democrat. It's going to be somebody like Bernie Sanders or Elizabeth Warren, who's proposing these really aggressive changes to how the financial system works. One of those guys is going to be nominated. So those ideas are going to be debated pretty soon. And it'll be interesting to see how it turns out because, it's not clear you can win on something like that, but it's not clear that you can't either. So we're going to find out in another year.
Yes, we are. And it's going to be interesting to say the least. Anyway, check out John's work over at dollarcollapse.com. Check out us, financialsurvivalnetwork.com. John, we will catch up with you next week. It's getting interesting. We'll see what happens soon.
See you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.